Good morning, everybody. My name's Robert Stevens. I'm a chartered surveyor with 30 years' experience in automotive property, and I advise both retailers and OEMs. But I'm a consumer too, having owned new and used cars in almost every segment, and so my views are to some extent informed by my experiences as a customer. This morning, Richard Adams and I are going to take an in-depth look at motor retail property. I'll explain how property as an external factor will drive significant changes in retail representation. I'll move on to discuss the strategies necessary to guard against a misalignment of retailers' contractual property obligations and future operational demands, before concluding with a brief to-do list and some do's and don'ts. Richard will go on to explore the future property landscape. From a physical perspective, there's been very little innovation in automotive retailing over the last 50 years. And most new builds still follow the traditional sales and service model. But the world's moved on. Internet sales, greater gender equality, and COVID-19 have changed shopping preferences, and consumers' expectations have been raised regarding quality of service. This has been building over the past decade, with other retail sectors adapting much faster. The industry can learn from the successes and mistakes of others, but it's important to act now, cutting out the dead wood and establishing the structural elements of a future retail distribution network. I'd argue this calls for a coordinated approach between OEMs and retailers, as it's been our experience that one can't adapt without the other. Let's begin by addressing the elephant in the room. The current retail model is broken, and full-service dealerships at historic densities of representation are no longer competitive against alternative land uses. The demand for land currently sits at unprecedented levels. Traditional car dealerships are space hungry, requiring twice the site area of single-storey industrials, and in its current guise, the industry is no longer able to compete with other commercial sectors, who use land much more efficiently. In a competitive marketplace, it's survival of the fittest, and the automotive industry will need to adapt its retail model if it's to successfully compete for space. Of course, there's a lot of older motor retail property about, some dating back to the 1980s or even earlier. Often, this stock's owned freehold or is leased on a market rent basis. Whilst operationally inefficient, many of these sites are relatively benign in terms of their cost of ownership. In fact, research by a leading OEM last year showed there'd been no growth in automotive market rents since 2006. But these properties are nevertheless vulnerable to predatory approaches from other sectors, and the industry will suffer a net attrition of stock over time as the best locations are cherry-picked, leaving a discordant patchwork of representation. A far bigger legacy issue arises where manufacturers and large motor groups finance the development of new showcase dealerships on an at-cost basis under sale and leaseback arrangements linked to RPI indexation. I believe designs have failed to recognise the seismic shift in consumer retail preferences, and lease structures are inflexible and tied to inappropriate and unaffordable bases of review. Indeed, many of the West London showcase dealerships visible from the M4 have head lease rents which are around double the affordable rent based on the size and scale of the business within. The differential isn't as dramatic elsewhere in the country, but will still create problems in terms of future viability. I spoke earlier about property forcing change in retail representation. That's an important principle, and I'd like to cover it in a bit more detail. Whilst planning policy can help protect less valuable land uses, land will eventually find its way into its optimal use. The biggest threat currently comes from industrials, particularly trade counter. New build industrials in the southeast are now achieving £15 a square foot, increasing to more than £20 a square foot in London. Property investors perceive most alternative sectors to be risky, but they have a continuing weight of money to spend, so yields for well-let industrial investments have dropped to 4%, giving that sector massive reach. Let me illustrate just how badly motor trade property has been impacted by examining a hypothetical 2-acre site in the home counties. Let's assume it's being offered for sale in the open market and that planning policy locks out residential development and the discount food retailers. I think it's easiest if I summarise the numbers on a slide. First, let's appraise an industrial scheme based on a standard 48% development density. At a rent of £15 a square foot and a yield of 4%, a developer will be able to generate a capital value of £14 million. The cost of development, based on a typical construction cost of £950 a square metre, is £4.5 million. Therefore, the price of the land will be £3 million an acre on a residual basis, after allowing for associated costs and development profit. Now let's run an equivalent motor dealership appraisal. We'll adopt the same metrics, but we'll need to halve the density of development and almost double the unit cost of construction to £1,850 a square metre. I think you can see where this is going. Helpfully, we can disregard developers' profit if the development's procured directly, but investors are uncomfortable with the current automotive business model, and the industry can't secure funding at better than 5%. Rerunning those figures, we get to a residual land value of £1.25 million an acre, so we'd fall short of any industrial bid by about £3.5 million. If the site needs to be secured against all odds, perhaps because existing representation has been lost, then, against a market value of £3 million an acre for industrial development, the rent required to break even on the cost of development will be £700,000 an annum, a figure that's beyond the reach of nearly all traditional single-brand dealerships. Dialling in competition from the residential sector paints an even bleaker picture. There's a 2-acre former dealership site in New Southgate, North London, which was under offer last year at just under £30 million. The problem is, of course, most severe in the southeast, but if we rerun those numbers for Manchester or for Bristol, we see a relative deficit of £450,000 an acre, still a major issue for the industry in the long term. Provincial areas are better able to balance supply with demand, but the opportunity in terms of vehicle park is lower. So we have a choice: suffer a slow, uncontrolled period of attrition driven by external market forces, or begin to rationalise the density and nature of future representation to build resilience against competing land users. In addition, by taking decisive action now, we create an opportunity to discard expensive ongoing property obligations and to release much needed capital. To summarise, car dealerships have traditionally occupied high-profile sites on suburban A roads. This is no longer sustainable. Sites in these locations are in high demand from other sectors, particularly the food discounters, self-storage operators, and from the care home sector. Over time, most motor retail property that's held in leasehold ownership will migrate to higher alternative use values as landlords elect to maximise the return from their assets. Retailers who own their properties freehold will measure the profit generated in existing use against the redeployment of capital in more efficient retail structures. These realities make it necessary for retailers and OEMs to plan ahead and redefine the provision of accommodation in line with future operational requirements. So, what are the action points in terms of your immediate strategy? First, accept change is coming. It's important to maintain as much operational flexibility as possible. Property's relatively illiquid, so delivering new strategies requires a long lead-in time. Be proactive and establish a plan now. Next, control your leasehold commitments and close off exposure where possible. It's sometimes possible to work with landlords to identify third-party demand, enabling leases to be surrendered early. On the other hand, signing a new 25-year lease geared to RPI indexation is the preserve of a limited number of premium brands, and as a retailer, I'd want that commitment underwritten by the OEM. Lease expiry affords the opportunity to renew on shorter, more flexible terms, or simply to walk away. Drive operational efficiencies. An increasing number of OEMs are permitting multi-franchise sites. Why not diversify into complementary retail activities? For instance, micro-mobility, which follows a similar online physical discovery path, but places less demand on space and presents cross-selling opportunities. Increase scale. Work with OEMs to establish future-proof market territories. Not every town needs a point of sale, in the same way as not every town needs a John Lewis or an IKEA store. On the other hand, customers don't expect to drive an hour to a service appointment, and collect and drop isn't viable at those distances. So a local network of service factories serving a portfolio of brands, ideally sharing the same parts bin, is therefore sensible, even if this requires investment in new after-sales premises. Finally, keep property commitments flexible and short-term in keeping with almost every other retail sector. A 10-year lease with a tenant break at the 5th year sits at the upper end of the risk profile for most tenants. This is a good strategy in periods of change because the industry will need to address mobility as a service and autonomous, the latter bringing about profound changes in all real estate sectors. Looking further ahead, I believe the online customer journey has removed the imperative to locate motor retail sites in highly visible locations. Once a customer's identified a purchasing opportunity, that vehicle's location becomes a destination in its own right. This is well illustrated by the prevalence of successful used car supermarket operations in secondary locations. Speaking as a consumer, I'd be happy to travel an hour to view a car I'd shortlisted, and an increasing number of customers are happy to complete their purchasing journey entirely online. Once that premise is accepted, one can drive efficiencies by locating motor retail businesses in flexible, scalable environments. Historically, car dealerships have tended to be bespoke. I believe that's no longer necessary. Validation of choice within the new car sales environment will be fulfilled through a variety of physical environments. Used car sales work well in the supermarket format, whilst grey box solutions for servicing and PDI, ideally multi-brand service factories allied to one or two OEMs, will eliminate many of the inefficiencies discussed earlier. Foregoing bespoke building designs in locations favoured by other, more profitable land users will greatly reduce the property overhead and ensure there's scalability and inherent flexibility within the property solution. Furthermore, if brands are aggregated, then it may be possible to level the playing field with alternative land users and to save some of the high-profile, high-rent locations which have been procured over the last 20 years. In terms of implementation, for those that haven't done so already, I'd strongly recommend you begin reviewing your property commitments now. Develop a property strategy based on scenario modelling and stress testing, and implement it in a controlled fashion, bearing in mind even straightforward property solutions can take up to 3 years to deliver. Sadly, we've seen a number of distressed sales where there's been no time for optimisation of the underlying asset and value simply being given away to purchasers in the form of risk pricing. On a positive note, we've seen significant engagement from key retail landlords, developers and end users across a range of alternative sectors. They're either actively managing or building their portfolios, and all are keen to engage with the motor sector. If there's a conversation to be had over a planned migration path or a controlled exit, then engage early. This applies equally to the residential market, where a de-risked acquisition, which can take up to a year to secure, will deliver the highest realisation price. Finally, I'd encourage you to take good advice from experts you trust. Developers and some landlords can be just as sharp as the sharpest car salesperson. I hope you found this discussion interesting, and I'll be happy to answer any questions after Richard's talk. Thank you for listening to me today.
Good morning, I'm Richard Adams. I've had 30 plus years working with Volkswagen Group, with experience in dealer facilities and network strategy before becoming head of retail property. There I was responsible for developing a 200-strong retail property portfolio for all Volkswagen Group brands and responsible for all stages of the property cycle, from design, acquisition, construction, funding, through to property management. In 2019, I left Volkswagen Group and set up Ascendia, focusing on the industry-wide need for better real estate planning as part of the overall business strategy. Ascendia advises on real estate strategies and helps manufacturers, retailers and external players like major property cos plan and deliver new automotive solutions. I have been a non-exec director of 3 SME motor groups, and I'm therefore aware of the issues and challenges faced by the principal stakeholders. I've also experienced firsthand the issues discussed earlier by Robert Stevens, balancing the delivery of both brand and retailer objectives, competing for premises, and flexing property to meet changing demands. Before leaving Volkswagen Group, there was a clear understanding that product technology and digitalisation would have a fundamental impact on future retailing and on property holdings. As I speak to you today, the relevance of this has been underlined by recent events. We can see how COVID-19 has had a permanent effect on customer priorities and behaviours, and the need to address the government's accelerated programme of migration from ICE to electric vehicles. In summary, there has never been a greater need to plan for the future. To set the scene in discussing the future of property and automotive retailing, I'd like to start by identifying the drivers for change. We are all familiar with the dealership, the combined sales and service facility that has been the basic building block of franchise networks for decades. In addition to the property challenges described by Robert Stevens, we also need to explore the changes happening within the automotive industry and how current opportunities within the property market can be used for implementation of future strategy. We can't predict with any certainty how fast the retail landscape will evolve, but we can understand the drivers. I will briefly cover a few examples which are relevant and have an impact on property. The adoption of electric vehicle products is being accelerated by the government, and this will shorten the life of ICE vehicles. One expected impact of electric vehicles is a reduction in vehicle servicing hours and parts/consumables sold. Whilst the effect on after-sales revenues will be gradual, it adds to the background decline in after-sales contribution and weakening viability of the retail business model. New digital capabilities are changing how businesses and customers interact. Customers have greater choice who they interact with, be it traditional retailers, manufacturers, intermediaries, or new entrants. This choice extends to the purchase journey, from the early stages of product discovery to online transactions such as service or test drive booking to full online purchases. Customer preferences are evolving, being enabled by e-commerce and digital capabilities, and with businesses developing this for competitive advantage. COVID-19 has underlined trends that were being established prior to 2020, and if some purchasers were comfortable with an online purchase journey previously, that number has increased dramatically and validates e-commerce sales channels. With manufacturers selling direct, the traditional boundaries between manufacturers and retailers are changing. The existing franchise structure is likely to evolve, and we can already see agency arrangements emerging. It's too early to make predictions, but feasible to consider possible changes as to who invests, makes commitments, and bears the property risks. All of these above factors have potential impacts on the retail landscape and ultimately the property requirements, and have the opportunity to facilitate a greater range of efficient and affordable property solutions. I would like to give you a few examples in the way which property can support the business as it evolves. The dynamics of the business and current property model are changing, and this creates the opportunity to disaggregate new car sales, used car sales, and after-sales activities into separate and more viable property solutions. Today's retail business model delivers the same density of sales and service points through networks planned as a balance between aggregated customer convenience and the viable scale of a combined business. We know through research, customers will travel further for the right sales experience. And we believe brand networks of 100 to 200 nationally today will reduce significantly over time. It helps to look at other specialist destination retailers. Some of these, such as John Lewis, IKEA, and Costco, all have lower densities of physical sales points, typically between 25 and 50 points nationally. Conversely, we believe customers will continue to demand convenient and accessible geographic access for vehicle servicing. With common technology, multiple brands under single ownership, and greater digital interfacing with customers, this enables the growth of service factories, manufacturers permitting. Assuming today's service density equates to the future requirement, The combination of scale and different property considerations should make this more attractive. Removing the constraints of being tied to expensive, high-profile sales locations opens up the choice of property, location, and the use of standard buildings, which are scalable, more flexible, and available in the market at lower cost. The higher density can also be leveraged to extend to offer a wider range of services and enhance utilization in the customer offer. For example, adding test drive and car handover capabilities and possibly virtual reality experiences. And as such, they become customer fulfillment centers. Used car retailing is already finding its way with used car supermarkets, major used car businesses, and new online channels establishing their position. The model, driving efficiencies with economies of scale from large regional facilities and strong online presence with relatively low property costs, looks right for the future, and we don't see any reason for change. Considering vehicle sales, there is no longer an imperative to go into a car showroom to research, select, and buy a car. And consumer research also shows us some customers don't like the current sales experience. But whilst online activity is a growing trend, physical retail presence is still required and important today. This is underlined by the retail sector, who are more advanced with e-commerce, but largely still require and desire a physical presence. However, this is part of a blended retailing solution, not an entity in itself. As the automotive retail ecosystem develops with e-commerce, new customer trends, and the next generation of digital showrooms, we see the formats, locations, and sizes changing. It is evident destination retailing needs fewer points than today's networks, and this creates space for us to develop new and exciting ways to engage with potential consumers. The solutions may differ, ranging from the traditional, those embracing digital/physical solutions, product showcases, to spaces enabling customers to validate choice and engage with brands. For property, the reduced number of points may allow greater investment in better quality solutions, and the metrics assessing the viability of each solution in a blended retail environment will need to evolve from merely being a cost center in isolation. As with servicing, it will be interesting to see how far brand clustering or multi-brand solutions develop. This will always be influenced by the manufacturers, but with brand awareness and product discovery increasingly being formed online, and the need to improve utilization and efficiency of property, we believe this will develop. One interesting experiment in a European retailer was a fully digital showroom with the ability to change brands digitally, an interesting experiment in creating a multi-use environment. This all sounds exciting. However, unless you're a new entrant, retailers and manufacturers have invested heavily in existing network properties. From our engagement with manufacturers, there has been widespread acknowledgement of the need for change, but consistently, the issue is how and where to start. We will always advocate a proactive approach, balancing future property requirements with current property obligations, and delivering a coherent strategy that maintains flexibility both through property design and commercial terms, aimed at lowering network costs. Some of the key considerations being high property utilization, scalable design, limited bespoke content, and maximum market attractiveness. So what changes are we seeing now, and what opportunities are available? In the short term, the brands and retailers' response to the economic challenge are network reductions and closing unprofitable businesses, thereby improving network and business performance. This trend may accelerate due to the economic impact of COVID-19 and will be more visible as 2021 unfolds. Short term, this stabilizes retail profitability or puts out the fire, which is vital, but does not deliver or address any need for structural change. We see little signs of change coming from manufacturers yet, but not surprising, as most are busy responding to the needs to develop EV and e-commerce capabilities and how these are delivered or integrated with their existing retailer networks. The property sector have not been casual onlookers. We have seen significant interest from the wider property sector. In particular, the larger UK property companies have engaged with us, wanting to understand how they can get involved and support the industry. They all have ideas, most have retailing expertise, and interestingly, the earlier solutions have focused towards creating exciting, engaging, clustered brand experiential environments. Clearly, they have a vested interest, with many impacted by the erosion of high street retail, and a post-COVID landscape are looking to attract motor retail to their portfolios. And this opens up the ability to secure attractive and flexible terms. I will now briefly touch on some of the proposals that are in the marketplace or in the pipeline, which illustrates some of the ideas emanating from the property sector. Starting with Axiom. This is the first new-to-market out-of-town shopping centre for almost 20 years. The new urban shopping centres were all opened over a period spanning the launch of the iPhone and the iPad. Central to its planning is the location, at the heart of the Northern Motorway network on the M62. It has a reach of 9.5 million people within 60 minutes. That is 15% of the UK population. It is designed as an entirely experiential and digitally enabled destination aimed at satisfying consumers' demands for experiential retailing. The scheme includes comprehensive food and beverage offers, space for motor retail, and expands the experiential content with the inclusion of an indoor gaming arena and many outdoor activities such as a new sports stadium for Castleford Tigers, swimming lakes and a triathlon course. The project is on course for construction to start, as the developers have now secured pre-lets from all the major retailers. The fourth mile. This is an ambitious concept, which recognises the difficulty of the automotive sector in retaining representation in Greater London. This mixed-use scheme includes 250,000 square feet of showroom and exhibition space for all modes of personal transport. It's located on the M4 corridor at Chiswick Roundabout on the site of the B&Q store. This is space for every brand and form of personal transport. It is intended as a destination for Greater London and the home counties, but may have national reach. I'll finish with the Westgate Ev Hub. This is a new dedicated EV transport store in the centre of Oxford, which we are closely involved in. It is a unique offer with the ability to showcase, demonstrate and retail EV products in a multimodal transport environment and available on very affordable and flexible terms. It can accommodate up to 5 car brands, motorcycles, scooters, bicycles, and has space for energy-charging companies. The design is centred around a coffee offering and is curated with a central host desk. The objectives behind the scheme are to attract greater manufacturer involvement in raising consumer awareness of electric vehicle ownership, product awareness, and environmental credentials. I hope these have been interesting, and in summary, we see the pressures on the current retail model being the change enabled by digitalisation, new technology, and changing customer behaviours, leading to a more diverse range of business structures and resultant property solutions. We see this as the end to the exclusive one-size-fits-all dealership, and some of the catalysts, such as disaggregation between sales and service, emergence of customer fulfilment centres, and new sales points, open up the opportunity for developing a strategy in which property can play its part in delivering affordable and flexible solutions. Hope you found this discussion thought-provoking, and I'll be happy to answer any questions you have. Thank you.
Good morning and welcome to this Automotive Management live virtual Q&A on motor retail property. I'm Tom Sharp, I'm News and Features Editor at AM Magazine, and I'm joined by the two gentlemen who have just given you an extremely insightful insight into the future of the property market and where we currently are today. Robert Stevens, Chartered Surveyor at RS & Co. Hello. And Richard Adams, Director at Ascendia. How are you two gentlemen today?
Very, very well, thank you, Tom. Yes.
Very well, thanks, Tom.
Great stuff. Thanks for joining us. We've already had quite a bit of engagement via the Q&A chat function, and I'll prioritise those questions as they come through, certainly. So I've got first question here submitted by Kerry Thompson. She says, how do you see customer demands evolving with respect to where they want to do business when it comes to car buying, particularly in terms of physical interactions? I'll leave it to you guys who wants to jump in on that.
Shall I go first, Richard, on that? Kerry, good afternoon. I think we're seeing a trend across all retail sectors towards experiential. So people want to see interesting and exciting formats. They want to be entertained, and I think that moves us away from the traditional car dealership format into something slightly different. I think it's also the case that for a lot of consumers, going to a physical location to view one brand and then having to go to a different physical location to view a separate brand is unnecessarily time consuming for them. They perhaps don't want that anymore. So I think we're trending towards something slightly different.
Same question to you, Richard. Do you want to sort of broach that?
Yeah, if I pick that up, if we look at the trends that we've seen escalated over this COVID period, we can see, picking up a point Robert said with regard to physical locations, consumers can access brands online. They can do it sitting in front of their tablet, their desktop, as I am now, and they can access a range of different brands, retailers, products, and services. And we can see the growth of online purchasing. We can see manufacturers starting to talk about, and I see Volkswagen have said the ID products are going to be retail direct. So I think in terms of physical, there will always be a requirement for physical locations, but the role of what a traditional dealership does, I think, is actually changing. Product discovery used to be the domain of manufacturers doing above the line marketing, and then brand building, brand awareness, and detailed product understanding all happened in the dealer showroom. That doesn't have to happen now, and we can see that isn't. So I think the role of the traditional dealership is changing. I think the key thing for me here, with regard to e-commerce and the changes of behaviours we've started to emerge, is customers have choice. They no longer have to go to a dealership, and I think it's the expression of those customer preferences that are going to help evolve the business and evolve what retailer property actually means and does in the future.
Yeah, quite well put. There's an awful lot of change on the not so distant horizon now, isn't there, really? We'll keep broaching these questions as they come through. We've got quite a few at the moment. So Tim asks, showrooms, particularly in prestige networks, are inflexible currently. How can motor retail property work harder and more flexibly in future? We'll carry on with Richard because he's got into his flow now.
Well, I think I use that motor dealerships are a one size fits all, very much dictated by the manufacturer's network planning, their standards. If you look at what's happening in the industry, you can already see signs of disaggregation of the existing business model. You can look at the trends and understand how that can evolve further. So you have a business that's and a property that has been structured to provide all of the services. The number and the cost base very much have been dictated by creating national coverage for all of those services in each individual location. That starts to become irrelevant. From a customer preference point of view, you don't need to have your car serviced in the same place as you go and buy and view a vehicle, and we know the business model doesn't actually support that. So we do see, looking forward, the ability of the industry to be far more efficient in terms of its property solutions, and at a property level, by disaggregating service, sales, used cars, actually find property solutions that are going to be more flexible, are going to be more efficient, and ultimately more affordable, which is what we see as a huge demand. As an OEM, you're certainly going to be looking at the cost of distribution and your retail route to market and wanting to take costs out, particularly seeing the massive investment in terms of new technology.
In the short term, we've got these big sites, and I've been aware of the headache that car retailers had making that space work for them, and I've come across a very small minority who managed to somehow negotiate with their manufacturer to get there was a Subway franchise, for example, in one site. Is that mixed use? Is there any sign that mixed use will take off? Will that become a thing? And why hasn't it so far? Is it purely down to the manufacturers just keeping it at arm's length?
I think without a doubt, the manufacturers' influence and the level of control and desire to have a focused business on one brand for the past 2 or 3 decades has been paramount. But with the challenges around the viability of the retail networks, individual retailer points, unless the manufacturer can do something to help the retailer become more efficient, either through taking out cost or increasing throughput, retailers increasingly going to be concerned. Will increasingly start to look at other revenue streams. One area we've seen, which we believe is complementary, is other forms of personal transport. So we've had conversations with a number of retailers where they're looking at products and brands such as electric motorcycles, are not space hungry, not capital intensive, that can sit alongside their established car brands. Don't require a great deal of effort. Customer base, you can get overlap. There are cross-selling opportunities. So you can already start to see and start to feel growth in those areas. I think time will tell with regard to manufacturers. I think the one trend that I expect to see in the not too distant future is where you've got companies that own, or manufacturers that own multiple brands. They have control over 2, 3, 4, 5 car brands. You look at the most recent creation, Stellantis, they've got multiple brands in their stable. There's opportunity there for manufacturers with the respective dealer networks to consolidate and start to bring more brands together, more products and services, and start to use the economy of scale, start to increase the throughput through the points that they've had. Because as you touched on, there are a lot of very expensive new developments. And property is inelastic. They're not going away. You can't suddenly change that property. And certainly if it's tied to a long-term funding commitment, you're going to be living with that for the next 5, 10 years plus. So the question is, how do you make it work? And if sitting with just one brand isn't going to work, something has to give.
Yeah, and Robert, I mean, I'll bring you in. We've touched on an awful lot there, but we're clearly talking about the efficiency and flexibility of sites, and I know you went into it in your presentation, but just addressing this question, and it was in particularly reference to the flexible, the prestige networks. I apologise. How do you feel that retailers can make their property work harder?
I entirely endorse what Richard's just said. I think the constraint currently is brand standards, and some of the prestige brands have imposed a huge ongoing financial obligation on their retailers in terms of 17 car showrooms plus. It makes perfect sense to me to mitigate that cost, particularly as we're now in an entirely digital research environment. It makes perfect sense to spread that cost by putting other things in alongside. Whether that's a food and beverage offer. Mercedes have done this in Germany quite successfully, or a complementary product line. But I think it's desirable because it creates something. It's something more interesting for consumers to engage with.
Yeah, clearly after the current situation we find ourselves in, when hopefully we can get people through the door for a multitude of purposes once again, sales and other things. I'll carry on addressing these questions because there are quite a few coming through. Isn't the OEM notion of showroom must relocate onto an arterial road to tempt passing trade simply expensive nonsense in the 21st century? I think you went into this, Robert, didn't you, quite early on in your presentation?
Yes,
I mean, it's still happening, but
Tom,
you know,
Tom, I can't disagree with that statement. Yeah, I look. Historically, they're there for a reason, and I think if you go back 50 or 60 years, cars were a very, very premium product. They were inaffordable to the masses, and I think it was the late 1950s, early 1960s when they became more affordable, and since then we've seen not only a levelling out of the playing field in terms of affordability of property to the motor sector, but the motor sector has been overtaken by by other land uses. So there are locations where I think that there are no substantial competing uses, and if the format works, then it's absolutely great to have it on an arterial road. But it's absolutely not necessary anymore.
I guess it depends on the support of the manufacturer, though, doesn't it? I mean, from a marketing point of view, what manufacturer wouldn't want to be in that key location where there's lots of passing eyes?
Yeah, and that's an interesting conundrum, because for us as we interface with the industry, there are two separate themes. There's network development, there's the network side of the business, and then there's marketing. Property is very expensive, but there's no marketing budget that's allocated to supporting physical locations. So you look at the you look at the sites in Chiswick along the elevated section of the M4 there. They are fantastic billboards for the brands that are in there, but as far as I'm aware, there's no marketing support that comes across to help that. And you look at the spend on TV advertising and magazine advertising, and you ask why. I personally, I think in a future world, we will have, there'll still be a need for showcase dealerships, but there'll be far fewer, perhaps half a dozen around the country in really key locations, and they will act as brand beacons. But yes, certainly not to the density that some prestige brands have been pursuing over the last 3 or 4 years. Yeah,
I guess I'd put the same question to you, Richard. I mean, it's easy at the moment, isn't it, where we're all sat at home and our window on the world is in these screens, to think we don't need these sites. But will there always be a need or a desire for brands to be right next to those key locations?
I think, look, Robert's talked about the economics or the viability of staying in or developing those key locations. I think there's an aspect to this in terms of priority of what is in the interests of the consumer, and I think the key point here is one of convenience. So if those arterial locations are convenient, they're easy, they're accessible, and they're affordable, they'll stay. If the route and the purpose or the route into the brand becomes more digital, you then start to question, how do you prioritize, or where does the priority of actually sitting on an arterial road sit in your list of objectives? And it feels like the priority of being on a main arterial road because you've got high visibility, i.e. creating awareness. When that awareness now is being developed online, it drops down a league or two. So you may not be prepared to accept such a high cost when it's not quite as important. So for me, custom convenience is really important. So if that location makes sense, it's easy, accessible, and it's affordable, it will continue. The other thing around roads arterial locations, they tend not to exist in isolation. The motor trade does tend to group together. So again, if you have an arterial location that is affordable and you've got multiple brands there, again, I think that will survive. Looking forward, one brand on its own Possibly not, and the property fundamentals may move away from motor trade being a desirable to retain in that location. But for me, the key is customer preference. Where do your customers actually want to travel to? What's actually convenient to them? And I think that the roadside awareness or visibility starts to reduce importance over time.
Yeah, perhaps car retailers have got a bit more of a need to pose that marketing question to the manufacturer partners in future. It might be something that's addressed when the agency model starts to become a bit more widespread. Who knows? We'll stick with the questions that are coming in. We've got one from Trevor Metcalf. Thanks for your question, Trevor. How quickly do you think manufacturers will move to a new format? Often retailers are limited by a longer term dealer agreement and long-term leases. Or are OEMs dinosaurs? Trevor asks. I think we've touched on this conversation just prior to the Q&A, so I'm keen to get back into it.
Hi Trevor.
Robert, you step in. What's the pace of change we're talking about here?
Yeah, I wish it were faster. I think the problem is manufacturers and retailers need to work together to find solutions, and that there's a degree of stickiness, I think, in the system. But you're absolutely right. That there are physical property constraints. A lot of retail property is held leasehold, and retailers are constrained by the terms of those leases. Particularly some of the big sale and leaseback deals where property is tied to institutional 20-year, 25-year leases. They are very difficult to manoeuvre, I think the solution there to moving the situation forward might be to look at multi-branded solutions for some of those big expensive properties, and indeed that's beginning to happen. So West London Volkswagen is now West London Volkswagen, Skoda and Seat. That makes sense.
And Richard, do you want to take that on? Is the pace of change fast enough? Each of these new openings obviously constitutes millions of pounds. The stakes are high, aren't they?
Yeah, if I just pick up on one of the points around dealer agreements, my experience has always been where you've got an alignment of objective or view between the manufacturer and the retailer, the dealer agreement, is not relevant. It doesn't actually hold you back. But when you look at the level of investment, and certainly some very recent investment in terms of brand networks, as Robert said, some of those are going to have very long tails in terms of level of a commitment. So for me, it's actually looking at the pace of change is going to be dictated by need. Need being maintaining viability in the retail networks. Maintaining competitiveness, because I think, as Robert said, there are many new entrants that are there that are taking a slice of the pie. So manufacturers do need to be able to react and to be agile. So I think certainly looking over the next 6-12 months, it's looking at manufacturers, how innovative can they be? We haven't really seen that at the moment. But I think there are some brands that are more capable than others. I don't see the change being immediate, but I think there will be some opportunities that we'll see arise very shortly. Certainly over the space of this year, COVID aside. So I think there'll be a push in terms of the need of the business to change. So I think that will create some change. Some of it will be downsizing to start off with, but I think there will be opportunities on an area by area basis that manufacturers and retailers will be able to grasp. But change needs good cooperation between retailers and manufacturers. And on that basis, as I say, I've never seen a dealer agreement actually get in the way where both parties want to travel in the same direction.
Yeah, it's an interesting dynamic to think who might be pushing for change faster, really. it did cross my mind. I think both of you spoke about new entrants to the market. Digitally led. Certainly, the likes of Polestar spring to mind. Do you think those franchisees of those new entrants who've sampled a digitally led retail model and perhaps a store location might be quicker to realise the benefits and in turn sort of lean on their manufacturers, their other manufacturer partners to evolve more quickly? Do you think that might be a dynamic that takes hold?
I think traditionally, I would see that pressure coming from retailers. I can't see an individual retailer or a group physically or practically they can't sustain a loss-making business. They have to do something. So retailers definitely are at the sharp end. But my experience in the conversations we've had more recently is manufacturers understand this. So I think there is an alignment that change needs to happen. It's just a question of what are those catalysts? I think retailer viability or retail viability is the prime driver.
Yeah, and I think I do recall one franchisee ducking out of a store agreement because it wasn't viable. So a lot of ducks have to fall in a row before I think these things start to be realised fully, don't they, Robert?
Well, the physical landscape's changed tremendously, actually, over the last, not just because of COVID, but over the last couple of years. So, what was a very expensive shopping centre implementation 3 or 5 years ago has become extremely affordable now. The shopping centre owners are very, very amenable to having discussions with the automotive sector, and I would encourage people to do that. And I think we will. We will see the rate of change accelerate because it's now far more viable to do that. And the really important thing, I think, is we can't predict what's going to happen in what the retail landscape is going to look like in 10 years' time. Nobody can. We can only guess. But property commitments need to be kept relatively short term and flexible. So 20-25 year institutional leases, they're right for some people in some locations, used fairly sparingly, but I think the pace of change is going to accelerate. That's absolutely certain. And I don't want to get into a debate about autonomous, but if we get level 5 autonomous, it will completely change everything we understand about physical property. Not just in this sector, but across the whole country. That may come. And yes, we need to have that inherent flexibility to deal with those changes.
Seems to be ever on the horizon, but moving further away, that level of autonomy, doesn't it? But we'll see how quickly that materialises. We're coming very close to the end of our time slot. So just very quickly, someone has asked, and it is relevant to many car retail groups who've got large premises for their corporate functions. James has asked more broadly, what's your view on large corporate offices, and will it be a long-lived trend for many? Either of you guys will say.
It's if I pick up. Good afternoon, James. Interesting whether that question is looking at retail head offices or manufacturer for that
Sure.
matter. Having a little bit of experience on this and certainly looking at the office market and office development over the last 12 months, it's certainly changing. I think there is always a need for offices. But for the reason the object or what actually happens in offices changes. There are a number of you can see a number of major financial institutions are saying, we as a policy now no longer require our staff to come into the office to work. We can have a 0 office hours policy. So I think there'll be a mixture. There are key workers. employees that work within a team that need access to tools that are location based. There'll always be a need, I think, to come together for physical interaction. But purely from a design point of view, which is something I'd spent the last 2 or 3 years looking at in terms of offices away from motor trade, I think the key for office developers and employers is creating an environment that people actually want to come to and want to work. And attend for human interaction, for collaboration, or their tools there. So I think offices will be smaller. I think they'll fulfil a slightly different function going forward.
Okay, great stuff. Quickly as you can, Robert. Do you think large scale offices are going to be a thing of the future, or are they consigned to dinosaur status?
I'd agree substantially with what Richard said. I think an HQ is desirable for a number of reasons, but I think in terms of size they will contract, but it does fulfil that sort of important that important status function, and allows people to interact and engage. Question I have is younger generations are far more comfortable with interacting with each other digitally, and maybe they won't feel the need to go in and talk over the coffee machine. I don't know, but
we'll be like this for some period of time, won't we? I think.
Yeah, my guess is we'll probably halve the amount of space that's required for
great stuff.
For HQ functions.
Thanks for that, Robert. We're out of time on the Q&A, but anyone who does wish to carry on the conversation with Richard or Robert can do in the chat function, which can be found on the main lobby page. Do engage and enjoy the rest of your AM Live experience. Thank you very much, Robert and Richard.
Thank you.
Thank you.
Thank you.